Okay, so again, welcome everyone to the Summit Library. Thank you for coming tonight for Pete Krull. And that's all I'm going to say. I'm going to hand over the introduction to Karen Venturella, who is also one of the librarians here, but she's more involved in this. So thank you, Karen.
Okay. So tonight's program is on the topic of sustainable, responsible, and impact investing. And it's being co-sponsored by the Summit Area Green Faith Circle and the Summit Environmental Commission, and it's being hosted by the Summit Public Library. Tonight's speaker, Pete Krull, is the founder, CEO, and director of investments at Earth Equity Advisors, a leader in sustainable, responsible, and impact investing. His firm is a 5-time best for the World Certified B Corporation and was selected to the 2021 and 2022 Rural Leaders 150 list of the companies with the most impact in the US. Pete was selected to the 2018 Investopedia 100 list of the 100 most influential financial advisors in America. He has earned the Chartered SRI Counselor designation from the College for Financial Planning, and he's a guest lecturer at Lenoir Rhine University, Western Carolina University, and UNC Asheville, as well as a columnist for Forbes and Kiplinger. He has been quoted in the New York Times, the Washington Post, Bloomberg, Investors Business Daily, and US News and World Reports, as well as several other publications. And he's a regular podcast guest speaking on sustainable and responsible investing. A native of Western New York, he lives in Asheville with his wife, Dr. Melissa Booth, in a solar-powered house and drives a Chevy Bolt electric car. So hopefully we're all going to learn ways about investing our money in ways that will have a positive impact on the environment. So Pete, we're looking forward to your talk. Thank you.
Thank you, Karen. Let's save the Q&A afterwards, if that works for everybody. I'd appreciate that. And you can, to make Karen's life easier, just simply put your questions in the chat box and she'll moderate from there. So I'm going to share my screen and we'll get started. All right, so like she said, we're based in beautiful Asheville, North Carolina. It's a rainy spring day or evening here now today here. So we're starting to see things bloom a little bit. I know you guys are a little bit farther north than us. Before we get started, as with anything related to investments, we need to make sure you understand this is for informational purposes and we are not giving any advice. We can only give advice to our clients. And that you always see past performance is not indicative of future results. So we'll just keep that in mind. So tonight we're going to talk a little bit about sustainable, responsible, and impact investing, as they said. I have been in this business for a long time. I started my firm in 2004, back when SRI actually meant socially responsible investing. But all along, this has been something that has been sort of the MO, if you will, of the traditional investment industry. You know, yes, the planet got destroyed, but for a beautiful moment in time, we created a lot of value for shareholders. And I like to start out with this because our goal is to sort of turn this paradigm on its head, because you don't have to create the environment, you don't have to destroy the planet to actually do well investing. This gentleman is Bill McKibben. He started 350.org. And when we first moved here to Asheville, he visited here. And one of the things that I took out of the talk that he gave, you know, he said, we're not the radicals. He said, the radicals are the ones who are willing to change the chemical composition of the atmosphere just so that way they can make more money. And that's not a paradigm that we really want to buy into. So let's talk a little bit about what is SRI. Again, like I said earlier, sustainable, responsible, and impact investing is what the newest version of the acronym is. It has a storied history going back to the days of, you know, when say religious folks, for example, didn't want to own tobacco, or they didn't want to own alcohol, or didn't want to own gambling. So that was some of the original aspects of it. Then we moved forward a little bit into the green movement of the late 60s and early 70s when folks didn't want to own polluters. We go to South Africa and the apartheid regime, where there was a divestment movement that was instrumental in helping to get that regime out of power. It is the fastest growing segment of the investment industry, and it has been for quite some time, almost as long as I've been in this business. And obviously a while back, we started out with not a lot. This is the last report. There will be a new report coming out this year. They come out every 2 years. But you can see here that going back to 95, when there wasn't really a whole lot of money there, now we've got almost 17 trillion, that's with a T, trillion dollars in some form of sustainable or ESG, which we'll talk about in a second, or shareholder advocacy. So it's grown tremendously, and it's especially grown. I'll be interested to see once the 2022 version of this comes out, because the SRI and ESG grew tremendously during the pandemic. We almost doubled our assets over that time from new people coming in who wanted to invest sustainably. I think one of the reasons is because everybody was stuck at home and had a chance to look at their statements and saw, hey, you know what? I own Exxon. How can I own this? We need to do something different. So I mentioned or alluded to ESG earlier, and this is something that I write a lot about. I've got a Forbes article that's gotten quite a bit of coverage on this. So the difference between SRI and ESG is really important. So ESG, which you probably see quite often nowadays, means environmental, social, and governance. And what it is it's a tool for assessing securities. It's a tool for doing analytical research. And it's used from they're trying to use a quantitative approach. So they're trying to put numbers associated with each one of these different aspects of a company. But they use a best-in-class philosophy. So the way we look at that is if the class that you're comparing against is a bunch of fossil fuels, then they're probably not going to ever really score very good. But because they use indexes, a lot of times you'll find those in these ESG indexes. And at the same time, this can be gamed. So let's say, for example, you're a fossil fuel company again, and you're never going to get a good E-score in the environment. So what do? So, on the S side or the social side, you might increase your charitable contributions. On the G side, on the governance side, you might promote a woman or a person of color to the C-suite or to the board of directors. And our view on this is just because you're doing these particular things to increase your ESG score doesn't make you a more responsible company. It makes you more of a deceptive company. And so we really, you have to look at some of these ESG scores with a grain of salt. So on the other side is sustainable, responsible, and impact investing, or sustainable investing for short. It still does incorporate the ESG metrics, but there's more of a human involvement to it. It's more actively managed. It's not just taking a bunch of numbers that are based on ESG and then creating an index and investment out of it. It adds what I call the smell test, because a lot of times, and I'll show you some examples a little bit later on in the presentation here, when you look at the underlying holdings of a particular investment, and if you have to ask the question, does it make sense that McDonald's is in a responsible portfolio? It probably isn't all that responsible of a portfolio. And the way we look at sustainable investing is that, it combines environmental awareness with social good and direct impact. We want to see not just the environmental positives, but we want to see equity. We want to see direct impact on people and communities. And I like to because there's such a quantitative component to the process, there is a qualitative component to the sustainable side of things. So this is the part of the Forbes article that I was referring to earlier. And the way I look at ESG is it's about making portfolios less bad, whereas a sustainable portfolio is about making them, finding companies that are making a positive difference and being more intentional about it. And this is probably the best example I can give. An ESG portfolio that reduces its exposure to ExxonMobil is simply less bad. And that's what we see in a ton of different portfolios. One that eliminates it entirely is better, but one that substitutes for solar is an actual sustainable portfolio. So it's how you look at the positivity, the intentionality of the portfolio. So traditionally, SRI is three components. There's screening. So there is looking at the kind of companies that you want to have in there and how they're performing in different areas. Again, and I've got a list here, I'm not going to read them off to you, but environmental track record, product safety, human rights, community involvement, et cetera. Things that make for a good quality, responsible company. And some of the things that we see investment managers are screening for, some of the criteria that they're looking at, obviously, are things like climate change, board issues, and board issues can be anything from separating the CEO from the chairman to diversity, both gender diversity and racial diversity, et cetera. Executive pay, we all know that every CEO that gets a multi-million-dollar pay package deserves it, right? No, not really. So these are the kinds of things that we look at. The second is shareholder advocacy. So how can we act as shareholders to push companies to be better? And again, you'll see some crossover here between the screening side and the shareholder proposals that are filed. One of the biggest, of course, is corporate political activity. And corporate political activity, if we go back to the Supreme Court case that allowed corporations to make contributions to PACs and different things like that. We at least want to see some transparency in that. We want to see where that lobbying money is going, where that political action committee money is going to. Climate change, again, executive pay, et cetera. These are the different things that shareholder resolutions will be filed on that are meant to push companies to be better. And the third aspect of SRI is always community investment. So making sure that a certain portion of investments go to serve typically underserved communities, and they might be used for things such as job retraining or low-income housing or access to healthcare. And we try to make sure that all the portfolios that we put together have an aspect of community investment as well. So we talk a lot about divestment, and the reason we use divestment as a tool is because it basically is removing an investment because it's not aligned with our values. But we use it because shareholder advocacy will not work. And how do we know that it won't work? Well, because there's companies like Exxon that the core of their business is the core of our climate issue, this existential issue that we're all dealing with right now. They're not going to change. They're going to continue to pump CO2 or to pump oil, which is eventually going to pump CO2 into our atmosphere. They have actively, funded misinformation campaigns about climate change for decades now. This is not a company that shareholder advocacy is going to make a difference with. So we do not want to own a fossil fuel company that's doing that. So again, the reasons we do it are to align our investments with our values. Another is to shape public policy to make sure that we're getting out there. I showed you Bill McKibben earlier. His 350.org group has been very much in the spotlight over the years, both good and bad, but really trying to push the divestment movement, especially on campuses and with endowments. But it's not just about values. It's also about financial risk. So when we look at this chart here, and it's can be a little confusing, so I'll do my best to explain it here. But if you look on the chart on the right there, you see these two lines here. So the red line is the number of coal reserves that we have. The blue line is natural gas, and the gray is oil. And so those are the number of reserves that are still in the ground. If you see the solid line, that is the amount of carbon that we can extract. So that is the amount of coal, gas, and oil that we can extract and still hit the 1.5 degree Celsius target. The dotted line is 1.75 degrees. So what we see is everything above that line is what we would call stranded assets. It's assets that we can't extract. In fact, we probably shouldn't be extracting any of those at this point. But this is a risk here because what's a company? A company is valued based on a number of things, a couple of which is its cash flow, but another is the assets that it has. And if it can't extract those assets from the ground, the value of that company is probably going to go down. And that's why it's not just about, us feel good and not wanting to own oil. It's about being fiduciaries and making sure that, this is going to happen at some point, and they're not going to be able to access those reserves and those assets that they have on their books. And when we look at the investment performance, I just created this, I think yesterday. The yellow line is the S&P 500 over the last 10 years, and the blue line is the energy sector over the last 10 years. Which would you rather have been involved in? The one that got a 53% return over 10 years, or the one that had a 289% return over 10 years? Energy has basically done nothing. You see a little uptick of late because of what's going on with Russia and Ukraine. But we don't necessarily see that being something that's going to be an extended rally. But more importantly, divestment is about reallocating. Where can we take that money that was in a cause of climate change and reallocate it into solutions that will help us to do better? This is Jeremy Grantham. He is a hedge fund manager. He was curious. He said, what happens with investment returns if we extract any particular sector from the S&P 500? So they took a look, and this is from 1989 to 2017. And you can see that if you took healthcare out, you actually did a little bit worse. They did 9.44 versus 9.71 for the S&P 500. But if you took out energy or fossil fuels, you actually did better. You did 9.74 versus 9.71. You did better from 1989 to 2017 if you didn't have energy in your portfolio. So I took and extended that out from 2017 through yesterday, and it continues. You can see that without fossil fuels, since September 2017, it's been up 99.25%. And with fossil fuels, it's up 98.89. Now, it may not seem like much, that's 0.35, but you could see since 1989 over that period of time that there is a big difference. And so there's what we hear a lot of times from traditional investment advisors is that you can't exclude anything out of the portfolio. You have to have everything in there. This shows you that you can invest with your values, that you can exclude the things that are the cause of the problem and not hurt yourself financially. So I'm a hockey fan. I'm from Buffalo, so you can all sort of laugh at me for that because my team hasn't done well like forever. But Wayne Gretzky had something famous that he said. He said, skate to where the puck is going and not to where it's been. And I think that's something that we can apply to our investment strategy. In fact, that's something that we apply to our investment strategy. So when we reinvest, what are the things that we want to own? Well, alternative energies, energy efficiency, batteries, water is going to be a major issue going forward, not necessarily privatizing water. We don't believe in that, but distribution, filtration, efficiency. Green transportation, we see EVs continuing to skyrocket in terms of sales, natural and organic products and services, sustainable real estate, one of the biggest users. Obviously, transportation is number one, but one of the bigger emitters is real estate. So how can we make real estate more energy efficient? We want to buy companies that are retrofitting their buildings to be a lot more efficient. IT. The more data we have, the more efficient we can make our processes. Green finance, insurance. One of the things that I talk and have written about as well is insurance, because the insurance industry in one fell swoop could get most of industry across the board to change their ways. So let's say, for example, you're a manufacturer, you have a manufacturing plant that's on the coast that gets inundated with hurricanes, different things like that. If the insurance company is not both either raising their rates or threatening to cancel them if they do something to mitigate those risks, that's a problem with the insurance companies. So insurance companies are the arbiters of risk, right? And they're the ones who could simply go out to industry and say, you need to do something about your climate change risk, because they have the data. Everything is there. And so, the European insurers are the ones that are taking it seriously for right now, not the US insurers. But that's something that we include in our portfolios, our financial firms that are taking it seriously. Recycling, circular economy, green building technology, which goes back to sustainable real estate, and cutting edge biotech. I'm a strong believer that a sustainable society is a healthy society, and anything we can do to nurture that is a positive. This is a friend and client and colleague here. This is Catherine Wilkinson. She was the lead author on the book Drawdown. Anybody who has read this understands a little bit about there are many different ways that we can address the climate issue. So if anybody doesn't have, well, first of all, if you're a client, when you become a client of ours, we send you a signed copy of the book. But if you haven't seen it, check it out. But one of the things Catherine said, and sustainable investing isn't just about the environment; it's also about gender equity. She said, gender equity is on par with wind turbines and solar panels. Doesn't mean that women and girls are responsible for fixing everything, but they probably will, which I couldn't agree more with. My wife has PhDs in microbiology and molecular genetics. She's definitely much smarter than I am. And interestingly, as we were going through the pandemic and microbes were a lot of what was going on, she was a great guide as we made investment decisions. We knew a lot and we learned a lot about what was going on in the world, and we made investment decisions based on her expertise. So that's just a little prop up for her there. So if you're investing on your own, how do you know which funds are truly sustainable and responsible? So this was at the end of 2020, there were 392 different exchange traded funds or mutual funds that had some sort of label as being sustainable or ESG or something like that. As of yesterday, there's 557 now. So it's even harder to try and figure out what is sustainable, what's, remember earlier when I described what's the difference between ESG and sustainable investing? Well, you have 557 options. Good luck trying to figure that out, because a lot of them are greenwashing. I haven't used that term yet, but obviously greenwashing is saying something is green when it really isn't. So let's do some due diligence here, for example. So everybody's heard of BlackRock and iShares, I assume. They've got a fund called the ESG Aware MSCI USA ETF. That's such a mouthful that I have to take a drink of water here. This is a fund that came out a couple of years ago, 2016. It's raised over $25 billion since then. It has, and in 2021 alone, it added $10 billion. So it's a massive, massive fund. It's the second largest fund in the US, the first being the Parnassus Fund, which I believe started in the early 90s. So that tells you the difference there and how fast they've accumulated assets in this, because they have a marketing machine, BlackRock does. One of the major rating companies for ESG investing is a company called Sustainalytics, and we use some of their data, but they give it a 4 globe rating. So 4 out of 5 globes. So they say that it's pretty sustainable. MSCI says it's a AAA rated ESG fund. If anybody's interested in reading, there's a great Bloomberg article about MSCI and their ESG ratings and how not great they are. We'll just say that. So let's take a look and see what's actually in this. So in this ESG Aware Fund, the second largest sustainable, quote unquote, because they market it as sustainable fund out there, it's got everything from ExxonMobil so we've got big oil, we've got Facebook, which did a great job with spreading information, DuPont, Raytheon, which is a defense contractor, ADM, so we have big ag. We have sugar water, we have gambling, we have more Chevron, we have more fossil fuels, we have McDonald's, we have big banks, we have credit cards, we have mining, we have Fox News, we have Hormel Foods, Dow Chemical, ConocoPhillips. In what universe would anybody consider this to be a responsible portfolio? Certainly, I was on a panel last week in Chapel Hill at UNC and I had the audience raise their hand. I said, if you're buying a sustainable portfolio, do you expect to see any of these particular stocks in there, and not a single hand went up? Which I wasn't surprised. That's one of those questions you should probably know the answer before you ask it. But yeah, that nobody said that they would expect to see anything like that in there. We manage a portfolio called the Green Sage Sustainability Portfolio. It's been around for about 10 years. And it's got a bunch of different things in there. It's got everything from Allbirds, which is a B corporation, like Earth Equity is, Amalgamated Financial, which is also a B corporation. We have Sustainable Agriculture. We have Beyond Meat, which is plant-based. We have EV charging. We have solar. We have EVs. We have equity in manufacturing with Lululemon. We have energy efficiency in semiconductors. We have Oatly, which is making oat milks and things. Proterra, which is making buses, EV buses. Pure Cycle, recycling batteries. QuantumScape, making batteries. Solar Edge, making parts that are inverters for solar panels. Twist Bioscience, which is one of my favorites, which focuses on making synthetic biology and DNA storage, etc. Can everybody still hear me fine? Okay, I was getting some feedback. Investis Wind Systems, which is making they make wind turbines. These aren't the kind of, I mean, in the ESG Aware Fund, you have Tesla, you have Lucid, and a couple of real estate investment trusts that we would own. That's about it out of 352, I think, holdings, something like that. It's the difference between less bad and being positive and intentional and investing intentionally. So when you're doing your due diligence, as if you're going to be investing responsibly on your own, you have to look under the hood. You have to take time and go to, you can go to Morningstar, you can go to Yahoo Finance. There's a number of different opportunities for you to look at. But if you want to really see what's under the hood, look at the annual reports for the mutual fund or ETF. That's where they have to list all of the holdings. So the annual and the semi-annual reports are the documents where they list everything that they hold. Ask the question, is it fossil fuel free? If it's not fossil fuel free, there's probably no way you can convince me that it's sustainable. Is it positive and solutions based, or is it just simply less bad? If something doesn't look right, it probably isn't. That's how I view so many of these, what did I say, 552 different funds that are out there. There are a few that are great. There are a lot that are less than great. And is it an index or is it human managed? Because if it's an index, it's probably just using ESG data to create a portfolio for you. It's not passing the smell test typically. And another is SRI a part of the company's ethic, or is it simply a marketing opportunity? There are several mutual fund companies out there that and investment managers that it's all they do is sustainable investing. It's not like a company like BlackRock or Fidelity or Vanguard that is added it just because there's a demand for it. It's because it's part of their DNA, if you will. So the 800-pound gorilla, of course, is what's the performance like? So 77% of sustainable equity funds finished in the top half of their Morningstar category for the trailing 5 years. So if we look at how categories are broken down, in the top half of their category, it should be 50% if it was statistically going to be broken up evenly. But sustainable funds have done so well that 3/4 of them have actually finished in the top half of their category. That says a lot. And 50% are in the top quartile. 50% are in the top 25% of their category. You won't see this pretty much in any other style of investing. And only 10% are in the bottom quartile. Only 10% are performing in the worst 25% of investment returns. That the argument that investing sustainably is charitable and is going to get you less returns or less performance, worse performance, I guess, just simply isn't the case anymore. And it's this data that we're pulling from Morningstar. So I'm going to show you a couple funds that we use in our portfolios. So the blue line, I couldn't make the green line be our portfolio because of how they did the graphing here. That would be more appropriate. But so this is all these that I'm going to show you are 5-year returns. And of course, past performance isn't indicative of future results. But so over the last 5 years, the S&P has returned 110%. This is the Brown Advisory Sustainable Growth Fund, which is a US large cap growth fund. It's produced 164% over the last 5 years. And you can see that it moves in a similar pattern to the S&P 500. You can see there's peaks and valleys at about the same time, but there's a margin of difference where it's outperforming consistently year over year. This is the Shelton Green Alpha Fund. This is a fund that personally I think is probably the most sustainable mutual fund that you can get. This is compared against the All Cap World Index. So over the last 5 years, that index has returned about 73, almost 74%, whereas Shelton has returned about 181. One of the, and I know the investment manager that runs this fund. Everybody, of course, here has heard of Moderna. You might have some floating through your systems right now. I know I do. Moderna was in this portfolio before anybody had ever heard of Moderna. Prior to the pandemic, they were looking at mRNA as a biotech opportunity, just like I told you earlier that we think cutting edge biotech is a really important aspect of sustainability. Garvin, their manager, thinks the same way. So well before the pandemic, you would have owned Moderna and you would have saw the upside, in which you can see with their performance here before anybody else did. We use the Thornburg Better World International. So it's not just domestic, it's also international as well. So the international index, the EAFE, over the last 5 years, up 37.75. And Thornburg's, which we use, up just shy of 80, 79.19%. Again, more outperformance. And even on the bond side. So over the last 5 years, the aggregate bond index up 832. One of the bond funds we use is the Brown Advisory Sustainable Bond Fund, up 1163. I mean, that's 3.3% higher on a bond fund. That says a lot. Touch more volatile, better returns. Our Green Sage Sustainability Portfolio, which we've been running for the last almost 10 years, it'll be 10 years this December. We've got a since inception return of 12.9%, which is 2.5% greater than its index, the All Cap World Index. Really proud of that. The last year has not been great, but nothing has been great in the in the innovation space, which is really where we would label this. So just really quickly, a little bit about our firm. We were founded in 2004. We only do responsible investing. We have clients in 22 states across the country. Like Karen said, we're a certified B Corporation. We've been a 5-time Best for the World B Corp, Real Leaders 150 list. I was in New York City back in November to receive a Luminaries Award for thought leadership in this category. We're a 1% for the Planet signatory. We give 1% of all of our revenues to environmentally focused nonprofits. We have 3 different areas that we work with folks. So we have our Align product. So if you're under $250,000, you can invest digitally online and have access to our Green Sage Sustainability Portfolio for only $5,000. If you're somebody who needs an advisor, would like an advisor, those are for folks who have over $250,000. And so we have somebody who personally works with you to invest with your values. And we also license our portfolios out to financial advisors who don't want to take the time or do the due diligence to understand sustainable investing. We'll actually license our portfolios for them to use, so that way they can have a sustainable portfolio without having to do the work that we have to do for it. So with that, Karen, if you want to do the questions, and our contact information is here. We've got all the different social media stuff, like of course everybody else does. So we can get started with some Q&A.
Thank you very much, Pete. I've learned a lot. I know that greenwashing is a real problem with funds where they say that they're green, but they're really not green. But we had a few questions. One question is, are there ETFs that are SRI? So I'm not quite sure.
There are ETFs that are ESG. There are, I'm not going to say that there are no ETFs that are doing sustainable investing. There might be a couple. Oh gosh, I'm trying to think of one of them. One of them is based out of Colorado. It's not going to pop in my head. The vast majority of because ETFs are typically index-based, they're typically passive. And so they're going to be based on ESG metrics. So you're going to see very little human involvement with them. So you have to be very, very selective on the ETF side. I'm hoping that that I'm getting those wheels turning here. It's getting late in the day here. That I'll think of the one I was thinking of there. Hunter Lovins, if anybody knows who Hunter is, she's been an environmentalist for a very long time. She's been involved with that particular fund, and it's going to kill me. Maybe if I think of it afterwards, Karen, I'll email you and you can share it with the group.
Another question is, what Morningstar category were you referring to for comparing to sustainable equity fund performance?
All equities. So basically all, I can go back to it. I think it will show it. So bear with me for a second here. Okay, so it's of their Morningstar category. So in other words, if it is a large cap growth fund, it's going to be a large cap growth category. If it is a large cap blend, it's going to be a large cap blend. So it's 77% in their particular category. So it's not a generic equity. It's based on the category of the fund. So if it's small cap, if it's international, whatever it is. So that's what the data is.
Okay, we have another question. Then I was going to sneak a question in, but so somebody said that they saw mention of ETF, like free ETF on the graph, and I think it was early in your presentation, and which specific ETFs are there? So I wasn't quite sure that question.
Can you be more, it looks like
so,
Tam Hankers is what it is right there. Can you be more specific about your question, please?
So, the person who asked that, they asked that early in your presentation. I wasn't quite sure what they meant by that, but maybe they'll clarify in the chat. But I was going to ask you a question. So you said that, well, has there been divestment in, I think there has been divestment in fossil fuels. I know some like Harvard and different places have divested. So have they quantified how much divestment there's been in fossil fuels, or if there's been an impact on that?
Remember, there's two things. There is pledging to divest and there is actually divesting. And that is where we see a lot of issues, is that a lot of institutional investors, like the Harvard endowment, like a lot of college endowments in general, have pledged to divest. But for some reason, they believe it's going to be a slow process. It doesn't have to be a slow process. So I don't have the actual number for you in terms of that, but I know it's a good size number that has been divested, but it's not anywhere near what it could or should be. So because again, I did some work with the Presbyterian Church USA a few years back, and was on a couple panels with them, where they were really trying to push the presbyteries to divest from their pension plans and from their other retirement plans. And I kept getting this pushback from the manager saying, well, we just simply can't sell it. And I'm like, it's not taxable, so you're not going to have a tax consequence. It's underperforming. It has consistently underperformed for the last decade. There is no reason to continue to hold this. And if you look at Jeremy Grantham's studies there, it shows that there's no reason to do it. And they simply couldn't get away from, there's a concept called tracking error. And tracking error really became popular if anybody lived through the .com era, like I did, where every single fund, no matter what your investment policy said, owned stocks like, I don't know, pets.com or things like that. And then when the .com crash happened, if you were a value-oriented stock, which probably shouldn't have had growth investments in it, you were putting growth investments in there because you couldn't keep up with the growth investors. And so they got hammered just like everybody else did. So tracking error was sort of came to the fore there. And what that means is it means that it's the difference between what an actual investment does and what its benchmark does. So a lot of a lot of managed funds that you see are only managed to a certain extent because they're really just sort of quasi indexes, because they've got they can only vary so much from the index, and that limits the ability to do divestment. That limits the ability to really have a sustainable portfolio, because and I'm going to stop sharing my screen here. That limits your ability to really have a sustainable portfolio, because you're always going to be linked to that index. And something that I've written about and talked about often is we really need to break that link between tracking error and investing going forward. Because like I said earlier, we can't invest going forward by looking in the rearview mirror, and tracking error keeps us attached in that rearview mirror.
I had not heard of tracking error. We have another question. What is the evidence that divesting from certain companies or investing in other companies has the desired effect in encouraging better or discouraging worse environmental social practices?
Divesting just simply is, there's no evidence that divesting does anything for the company other than create a bit of a downward track at the time that it was sold, okay, in terms of its stock price. I'm not divesting from Exxon to make a difference in Exxon, because I've already decided that stakeholder advocacy isn't going to change them. It's just simply not going to. On the positive side, I'll refer to Green Century Investments is really, really strong in shareholder advocacy. Leslie Samuel Rich, their president's a friend of mine. They have done a lot of work in things like sustainable palm oil. I'm just going to use that as an example, in getting a number of companies like the absolute leaders in palm oil production to transition their business from monoculture and you know, if anybody's, I've been to Costa Rica many times, and you can see the way that they create these palm plantations is unsustainable, like tremendously unsustainable. And I think when you go around the world to Southeast Asia, it's even worse. But they've been instrumental in getting the big players to change the way they do their farming, to change the way they do their practices. And if you go to Green Century's website, there's a whole bunch of information on their shareholder advocacy activities.
It's possible through shareholder advocacy that companies will change their practices. That is possible.
It is possible. It's not easy, and it takes everybody's input and takes everybody's pressure, but it's absolutely possible on companies where the core business model is not the problem.
You had talked about how companies will not be able to access assets that they have on their books. So what would be their incentive to transition or to do anything like differently than, you know?
They don't have an incentive other than, you know, ultimately regulation or simply being left behind. So if you know, we continue to see the adoption of EVs, and obviously I'm talking about fossil fuels, then those are going to be left on their books. Ultimately, you know, those assets are going to be left on their books because they're not going to have as much of a market. And it's not going to be financially feasible for them to extract them either, because the costs will go down at some point because of lack of demand. Is it going to be fast enough based on the IPCC's report that came out yesterday? Unfortunately, probably not. I try to be as optimistic as possible, but we have to get our stuff together, and we have to get it together really, really, really quickly.
I agree with you. I don't see, does anyone else have any questions? I don't see any other questions in the chat. I'm not very good at seeing if there's like people that have raised their hand or anything. reactions. Okay. So I wanted to thank Peter again for speaking with us today. I'd seen you speak at a university in North Carolina, and that's where I thought it'd be great to bring you to Summit, because I know a lot of people in our community do a lot of investing, and they want that to have an impact on our planet, I hope, and a positive impact. So I know personally I need to make a lot of changes in the way I do
it's
my
often
investing.
one of the things that I've said for a long time is, who our number one competitor is not, Vanguard or any of these guys. It's just simply folks who delay, who don't make the change, because nobody else is doing what we're doing. It's that, and as the word just popped out of my head here again. But it's not making that change. It's just sitting and saying, well, it'll be okay, or ignoring it. So, and it's really pretty easy to make the change, to be honest with you.
Okay, so I hope I'll make the change, and I hope maybe a few other people will. But if there's not any other questions, I guess.
Karen, I did have a question. This is Marty.
Okay.
I joined late. I had a conflict with another meeting going on at the same time. Couldn't quite be in two places at once, much as I would have liked to. Peter, I was curious if you had recommended some specific websites that people could check to see how different companies are doing with their actual divestment of their assets that might be oriented toward the green economy, the green environment.
So there is a website, I'm pulling it up here, fossilfreefunds.org.
I think you can mention that one to me. Yeah. Okay.
You can pretty much put any mutual fund in there, and it will give you a score and tell you how, it's not necessarily about divestment or anything like that, but it will give you a score based on the holdings. That's the best one out there. And they've got a number of different iterations of that as well. I believe they also have one for prison-free, gender equality, weapons-free, etc. So they've got a bunch of sister funds as well, and that is done by As You Sow, which is a nonprofit that does a lot of shareholder advocacy.
Thank you. And is there a recording of this program tonight that will be available?
I'm sorry, I should have mentioned that. Yes, there is a recording, and everyone who participated will be sent a link to that recording. Yes, it has been recorded. Yes.
Great. Thank you so much. Appreciate it.
Karen, I have a question. Pete, you mentioned a couple of funds that you were really very high on. I think one was Shelton Green Alpha Fund.
That's correct.
And I think, I'm not sure, I didn't write down all three of them, but the other one was Brown Advisory, and I didn't.
I know. So you're looking at the charts that I showed for the ones that we use for our portfolios. So
Right.
the ones those examples that I gave was Shelton Green Alpha, symbol is NEXTX. And again, remember what the beginning of this of the presentation said. This is not advice. This is for information purposes.
Right.
The second is Brown Advisory Sustainable Growth Fund, BAFWX. The third is Thornburg Better World International, which is TBWIX. So those are equity funds. And the fourth was a bond fund. It's the Brown Advisory Sustainable Bond Fund, which is BAISX, I believe is what the symbol is for that.
Okay.
The others I know for sure. I think that's the symbol. I've got 10,000 of them in my head, it seems like, all the time. So it's basically alphabet soup.
Just, would you repeat that last one? You said Brown Advisory, the bond fund?
Yeah, sustainable bond.
Oh, sustainable bond. Okay.
Yeah.
Okay, thank you.
And that Lord Abbott also has a climate bond fund that we use. I don't remember the symbol for that off my head, but you can Google Lord Abbott climate bond.
Okay.
Bonds are tricky right now, so.
Yeah, they are. I agree. It's a difficult
Okay.
time for bond investors.
So does anyone else have any questions? They want to unmute themselves or put it in the chat? No?
Yeah, I have nothing else to do. I can keep talking.
Oh, sorry.
Oh, no worries. I enjoy talking about this. I enjoy what we do. I think we definitely make a difference.
I need to thank you again for taking the time to speak to us. And I think like a few of us will likely make changes, and it will change the world, I hope. And so thank you. Thank you.
Thank
very
you,
much.
everybody, for your time and attention. And please feel free to contact us if you have any questions or if we can help at all.
Thank you, Pete, and thank you, Karen. Thanks, everyone, for coming out to the Summit Library tonight.